In this video, we're going to cover some miscellaneous important updates that you can receive. So first off, I'm going to cover what are important updates in the first place, how you can actually receive these updates, why they're so important to our process as investors, examples of these particular topics we're going to cover today, like different outcomes of the topics, and lastly, I'll cover where you can go to do some more due diligence on them. So for starters, what are important updates? Well, it's pretty much in the name, but it's a brief summary of an important development in the underlying business or stock that it's referring to. So today we're going to talk about a bunch of miscellaneous updates like buyback announcements, merger and acquisition targets, delisting announcements, legal issues and stuff like that. But in the other videos you may have seen, we talked about pieces like earnings reports, dividend changes and other topics like that. So how do you receive one of these updates? All you have to do is have a stock either in your watch list or in your portfolio, and it's automatically eligible to receive these important updates. Now, these updates will appear either on your dashboard or in your email inbox as well. So why are they so important? Well, these updates allow us to monitor the stocks that we're following and remain informed on the fundamentals. So part of the process as an investor is we want to remain up to date on these stocks that we're following, either the stocks that we're interested in buying on our watch list or the stocks that we already own in our portfolio, because ultimately we have a thesis around these stocks, like a potential thesis of the ones on our watch list or a thesis as to why we bought these stocks in our portfolio, and it's important to remain up to date on the fundamentals of the business and make sure that our thesis is actually playing out as we expected, and if not, to adjust accordingly. Lastly, these updates are important because they allow us to save time during the monitoring and research phase. So if we didn't have these updates delivered straight to us, we would have to maintain sort of our own due diligence process where we'd be researching the stock's quarterly filings, annual filings, and trying to discover these insights ourselves, whereas these are ultimately compile all the data to us and send them directly to us, which can obviously save a lot of time. So the last thing is these particular miscellaneous updates are directly from the company, and there's no real analysis from Simply Wall Street. So the other updates we covered, being the earnings reports and the dividend changes and such, we conducted a bit of analysis on the updates and then sent them through, but these updates are directly from the company itself. So let's have a look at the first example. Now this is when a company announces a buyback. And here's an example of one on the left-hand side here. You can see the company commences an equity buyback plan for about 52 million shares, representing 10% of its issued share capital under the authorization approved on September 9th. So there's details of the buyback here, but basically buybacks are one way of a company returning capital to shareholders. As opposed to dividends are very like a direct payment to a shareholder, whereas buybacks are indirect. So they basically buy some of the shares outstanding that are on issue, and as a result, as an existing shareholder, if you didn't sell your shares, that increases your ownership in the company because there's less shares outstanding. So it increases your percentage ownership of the profits. When a company announces a buyback, it's often because they have excess capital that they don't need in their business. So as a manager or an executive at a business, you have three decisions for the money that you're making. You can either reinvest the money back into the business, or you can distribute it to shareholders in the form of dividends or buybacks, or you can just hold on to the capital in the form of cash and choose to reinvest it or pay out a dividend at a later date, right? So there's three different options there, and a buyback is one of them, the form of returning capital to shareholders. With updates like these, it's important to note how much money the company actually plans on spending on its equity buyback. So we can find out details of that obviously in the announcement itself, but it's also worthwhile seeing how the company or what funds the company is going to use to buy back the shares. Is it going to be from future expected cash flows, like as in they're like, oh, we're going to buy back $10 billion worth of the next 3 years, or is it from current cash that they have in their bank account and they're saying, hey, we haven't got anywhere better in the business to distribute or reinvest this money, we're going to distribute it to shareholders in the form of buybacks. So once we know how they're going to fund the buyback, it's important for us to actually look at the company's future prospects. So we can see here the first place I would go to is the future growth section, and just to see how the company's earnings and free cash flow are expected to trend over the next couple of years, if that is how they plan on financing the buyback. Alternatively, if they plan on using it with cash that they currently have in their bank account, I would have a look at the company's debt to equity history and analysis section and just see how much cash they have on hand and how much as a percentage of that they plan on using to finance the buyback. Some companies can actually do buybacks via debt. So they've raised debt and they plan on then buying back shares to increase shareholders' ownership. And often that is quite a very risky way of doing it, because it's very inefficient and it's like not actually self-sufficient, right? It's not the company returning capital that it has made to shareholders. It's financing some capital to then repurchase those shares, but it then has to at some later date pay off that debt. So that's a very unique way of doing it, and it's not typically the most common way of doing it, but it can be risky when companies choose to do it that way. The next topic we have here is the merger acquisition target. So you can see some details here are basically a company being acquired by another company. And so there's details of the acquisition here. But what I would do if this news or particular update came through on my dashboard is I would go to the price history and performance section and have a look at basically any updates there. So I can see here that there's a few updates here that relate to the actual takeover. But back here in January, I can actually see, mid-January, I can see that there was the M&A rumor. So there was the talks of this company being acquired by someone, and it turns out that at the end of the month that news actually came through and there was a definitive agreement to acquire the company. So I'd read through these updates here just to get an idea of what was going on, and if I wanted, I could also read through both of the company reports and just see how they gel and like if there's any synergies that could occur between the two businesses given the nature of their business, or any sort of similarities where one company makes up for another company's shortcomings. So like it's buying it because it has a whole bunch of cash on its balance sheet, or it's buying it because it's a competitor, or it allows it to access a new market or a new product line, stuff like that. The next example of an important update is a delisting announcement. And this one's very simple. All it is basically a company releasing an announcement saying it's going to be delisted from the particular exchange it's on. Now, this can typically occur either if a company is not meeting its legal requirements or its necessary rules to be listed from the particular exchange that it's on, or if a company's actually been taken over. So this particular example seems like it was from a takeover. You can see here this M&A announcement back in October shot the price up to a particular around $6.50, and ever since then it remained at $6.50 as it seemed like the deal was about to come through. And then the announcement of the delisting came here, which is obviously confirmation that the merger actually went through. So for these kind of delisting announcements, I would go to the price history and performance chart again just to see the details of the updates and what was occurring, and then I would read through the company report of the new company that's actually taking over it if it is an acquisition. Otherwise, if it was a delisting announcement from like a company not meeting its necessary requirements to be listed, there wouldn't be much to read through because it's actually just going private for reasons that it wasn't able to meet its requirements to be public. The next example we have here is a follow-on equity offering, and that's basically if a company is raising money again in the form of equity rather than debt. And so there's details of an example here, and an example is like when a company wants to raise more money to fund its own projects. A company might choose to do a follow-on equity offering because it either has too much debt or it is in a position where it's got a really high share price, and it can raise the most amount of money thanks to the recent share price appreciation. One thing to keep in mind with follow-on equity offerings is that they can be dilutive, right? So as a company issues more equity in the business, if you don't increase your ownership yourself, that can decrease your slice of the pie because there's more people who have now become shareholders and everyone's slices have become less. It's often not the most encouraging thing to see because it means the business isn't able to be self-sufficient and self-funding, right? So if a company has a good business model where it's generating free cash flows, it's typically then able to fund its own growth, right? But if a company is doing a follow-on equity offering, it typically means, okay, well, we haven't been able to generate this money internally. We haven't chosen to go with debt either because they have too much or no one wants to lend to them, and so they choose to raise more capital via equity. Not the most reassuring sign. So the first place I would go is I'd check out the price history and performance chart again, like these similar updates previously, just to see what's been happening. And you can see it was back at $2.63 as the max it's traded at almost a year ago, but more recently it's down at about $1.40 or $1.30. So it's kind of concerning to see that the company has been decreasing in terms of value, and it seems like the company is in a bit of trouble here and trying to raise some more money through offering new shares in the business. I'd also have a look at the financial health section and the debt to equity history and analysis section section just to see how leveraged the company is, and also how much this proposed equity offering, where they plan to raise $30 million, how that would change the company's capital structure. Because ultimately, like, you can finance a company through two sources, equity and debt, and at the moment it seems like this company is utilizing a lot of debt, right? You can see this example has $101 million worth of debt, but there's only $40 million worth of equity to the business. So this would add about a $30 million worth of equity to business, and that could basically change the capital structure accordingly. So have it using less leverage. The final example we have here is lawsuits and legal issues. So this is an example of one of these on the left-hand side here, and basically just goes through that a company is actually announcing a class action lawsuit against a particular company, and the people who are launching the class action are encouraging long-term investors to contact the firm to take part of it. Class action is basically like when a legal firm decides to launch a class action against a particular company for some wrongdoings that they have done, and ideally they're trying to seek compensation for shareholders who have suffered from that time. So we can see here, over the last year, the company's share price has declined from like $26 to about $5. So it's not surprising that there's a class action that's come about, because shareholders have lost quite a lot of money in this period. So if this news came out, the first section I would go to is the price history and performance, just to get some context, see what's been going on. We can see the legal issues announcement came out recently, but special guidance, more legal issues back in October. They did a private placement, earnings updates, just these kind of things I would read to get some context on what's been going on. But ideally, if I've owned this business, I've been keeping up to date on these announcements already. The next section I have a look at is the earnings and growth forecast, just to see if this news of the legal issues has actually changed the analysts' expectations of the future, right? So if these legal issues come up and there's like a potential for a huge fine to be paid or huge remuneration to be paid out based on the damages that they've caused, that might change analyst estimates of the future, right? So they may have a decrease in their estimate for the earnings because of the fine that they have to pay. So I would have a look at the forecast section after the news has come out, and there's a bit of time for it to be digested, and just see if there's any lower estimates for the future. And because some legal issues vary in their severity, right? So some may be just like small sort of one-off fines they have to pay, and other legal issues could be like very severe antitrust issues and stuff that are against the company's like entire business model. So they vary in severity, and it's worth looking at this particular section to see how it impacts them, and also if that changes analysts' forecasts of the future. These changes in future forecasts that can occur could also impact the valuation expectations, right? So I'd also have a look at the valuation section if these forecast sections have changed as well based on the news from the legal issues. So that's been a quick summary of the sections I would go to get some more context on these particular important updates here on the left-hand side. Basically, I'd go to the price history and performance chart for the most part, because it provides all the recent news and updates and any sort of developments that have occurred, and they typically always relate to these sort of announcements given their pretty high importance. Next, I go to the future growth section for a few of these announcements, like the buyback announcement, to see if there's any like future cash flows expected, and that's how they're funding the buyback, for example. And I'd also go to the financial health section to get some more context on like the follow-on equity offerings and the buyback announcement, just to see if the company is like using internal cash to fund the buyback, or for the follow-on equity offering, if it has any like capital structure issues where like it's too leveraged or not. So I hope this video has been helpful. Thank you so much for watching.